Good morning. I'm thankful to Business Standard for inviting me to this summit. I'm thankful for the very informal and personal introduction by Mr. Tamal Bandyopadhyay. He had actually, asked me last year around. I couldn't make it. I apologized to him. I told him this year I definitely would. He remembered, and he remembered to call me, so thank you. I'm going to speak on fintech and regulation, just to, take you away from what you would normally expect central banks speak on. But before I start, I must apologize. My throat is acting up a bit. Last couple of weeks, I've been a bit hectic, going across temperature zones. So that has taken a bit of a toll, on the throat. But, bear with me. Year ends, we are coming to the end of this year, are usually a time for introspection, and 2022 clearly offers a lot of food for thought. On the bright side, humanity seems to be finally putting the horrors of COVID behind it. The rest of the story for the year is perhaps not so bright. The specter of war and geopolitical tension has reared its head again. We were told, in terms of economies, we were told in the late 1990s that the business cycles were dead and inflation has been conquered. After the financial crisis in advanced economy, the focus shifted to deflation, how to get out of deflation, how to actually create inflation. When 2021 was drawing to a close, the consensus among policymakers was that rising prices was a transient episode globally. That changed fast as inflation zoomed to multi-decade highs in many advanced economies and back in contention, as the primary macroeconomic problem to be fixed. Rising interest rates, volatile exchange rates, led by a strong dollar, and the consequent rise in debt burden, especially of sovereigns, has turned the narrative on its head. Inflation, it would appear, is giving a reality check to us all, policymakers and economists alike. In the much narrower world of fintech, with a much shorter history, one story, the story of cryptocurrencies, runs somewhat in parallel. We were closing 2021 with a narrative that finance as we know it, and as it's called in that lingo, TradFi, was slow, inefficient, and clumsy. And DeFi, decentralized finance, or DAOs, decentralized autonomous organizations, was the path forward, riding on cryptocurrencies with their blockchain technology. Crypto prices, in their own jargon, were mooning, and investors were hodling, holding on for dear life, again, using their terminology. Since May 2022, cryptos have lost some of the shine. They have lost about 2/3 of their value, and failure of some big entities there is seeing the ecosystem basically unraveling. The technology that heralded the end of governments, that was the underlying philosophy of cryptos, and regulators and intermediaries, is now frantically seeking to be regulated. Arthur Clarke, the science fiction writer, once said, all of you know that, of course, any sufficiently advanced technology is indistinguishable from magic. He would have perhaps used the word voodoo if he were to go by the promises peddled by crypto boosters. But crypto technology, of which cryptocurrencies is but one use case, is just one strand of the wider world of fintech. Financial sector has been going through a process optimization using technology throughout its history. Over the course of the 1980s and 1990s, banks in India have evolved through advanced ledger posting machines. Many young ones here would probably not remember that, to database management systems, to concepts like total branch automation, and finally to core banking solutions. A logical extension of this journey, as internet and mobile phone connectivity exploded, were internet and mobile banking. As of October 2022, there were approximately 33 crore active users of mobile banking services and approximately 7.5 crore active users of internet banking services. The revolution in data storage and processing capabilities has enabled non-banks to offer financial services such as peer-to-peer lending, crowdfunding, alternative credit scoring, open banking, etc. In the area of payments, the transformation has been particularly striking with 24/7/365 RTGS and NEFT, UPI, digital prepaid instruments, QR scans, Bharat bill payment systems, etc. Aadhaar-enabled payment systems has virtually revolutionized delivery of government benefits. New information technologies like cloud computing, APIs, big data, and AI/ML methods will ensure that fintech would be the dominant theme in delivery of financial services in the future. Now, fintech is generally described as an industry that uses these technologies that we just talked about to make financial systems and the delivery of financial services more efficient. The rise of fintech, lending platforms, open banking, payment apps is a major source of disruption to the banking industry and the financial industry in general. And these new business models and the transformation of existing businesses has brought new challenges for regulation. Regulators need to ensure that non-bank entities lying outside the regulatory parameters for banks do not undermine the role of banks, which would raise financial stability concerns. At the same time, there is a need for this efficiency-inducing new technologies to be incentivized. Clearly, the entity-based regulation of banks with its focus on health parameters like capital adequacy, leverage, liquidity, or financial integrity requirements like KYC, AML, CFT require to be adapted to the presence or to the coexistence, if I may say, of fintech entities that are not subject to the same regulatory requirements. The concept of activity-based regulation with the basic theme of same activity, same regulation has, in this context, gained currency. The fundamental point is that any entity providing banking services needs to be subject to similar regulation as banks. An arrangement where regulation of non-bank and fintechs are not aligned to the regulation of financial firms, regulated financial firms like banks or their subsidiaries, offering similar services will create inefficiencies and risks associated with regulatory arbitrage. Simultaneously, new risks associated with use of information technology like cybercrimes and frauds also need to be addressed if the wider population is to be encouraged to adopt digitization. How do we at RBI seek to address these emerging challenges, regulatory challenges? RBI plays a dual role as a developer of financial systems as well as a regulator. Its regulation is premised basically in the area of fintech on three principles. First, innovation needs to be encouraged. That's the first consideration we have. Second, innovation needs to be assimilated in the financial system in a non-disruptive manner. And third, of course, that the course of digitization should, at every step, ensure customer protection, user protection. These are broadly the three principles which guide our regulation in the fintech arena. In the payment space, RBI has played a role that is well recognized. Introduction of RTGS, NEFT, or check truncation system has been achieved with its own initiative. Extending RTGS and NEFT to 24/7 has opened up the scope for growth and internationalization of Indian financial markets. Setting up institutions has been another prescient move by the Reserve Bank. IDRBT set up in 1996 and focused exclusively on banking technology has led the initial stage of technology adoption in the banking system through the creation of Infinet, National Financial Switch, etc. NPCI, founded in 2008, has been a pioneer in digitization in the retail payment systems in India with its UPI, RuPay cards, AEPS, BBPS, and many other systems, establishing India as the leading country in retail payment innovations. RBI came up with guidelines on account aggregators as early as in 2016. With the traction that ecosystem is witnessing now, account aggregators are probably poised to bring in the next round of innovations in the financial services segment. P2P regulations came in 2017 when the sector was relatively at a nascent stage in India. We have instituted a regulatory sandbox framework in 2019 to incentivize adoption of innovative financial products or services in a controlled environment. The Reserve Bank Innovation Hub was set up for collaborating with financial sector institutions, technology industry, and academic institutions for exchange of ideas and development of prototype related to financial innovations. RBI, as well as the institutions it has created, hold regular competitive programs like the RBI Hackathon to provide a channel for the fintech and startup sector to showcase innovations. We have actually come up with some of the most striking technologies, what probably Arthur Clarke would have referred to as magic in the course of these competitions to address issues that seemed intractable, just 1 year back. How to, for example, use UPI on feature phones, how to use the payment systems in environments of, spotty connectivity, and so on. So there are some wonderful, exciting new technologies that have come up through these competitions. But no regulator has the luxury of letting innovation disrupt the financial system on the hope that market might reach its own equilibrium eventually. For instance, we cannot afford to let DeFi technologies loose on the financial institutions with virtually no understanding of how a bankless system would operate. Apart from the unacceptable financial stability risks, this would amount to a regulator working towards its own irrelevance. It is necessary that a regulator controls the manner and pace of absorption of new technology. At its very basic, every regulation, financial sector regulation, is essentially a process of slowing down change to let the system adapt, let the system adjust. Allowing disruptive technology without clarity on whether the alternative is even feasible, let alone desirable, would be an unacceptable gamble. A key element for smooth absorption of new technology is to ensure a level playing field. If offering credit cards requires a banking or similar license, allowing a non-licensed entity to synthesize them would amount to undermining the licensing system and the banking system, as this system would then be placed at a competitive disadvantage. Similarly, Digital payments is essentially a banking service in the sense that it involves movement of funds from one deposit account to other. We'll keep currency or digital currency out of it for the moment. Deposit accounts are a necessity for digital transactions. Technology merely a tool. Deposit accounts can make payments with or without any particular technology, but not the other way around. Facilitating a non-bank to use its technology to move deposits would amount to creating a competitive edge for that non-bank. It may be argued that non-banks could avoid use of bank deposits by maintaining deposit-like funds, say wallets. But then effectively non-banks would be doing deposit-taking activities. That is, they would effectively be functioning like banks, and which would require normally a banking license. A less disruptive and more efficient mechanism is to facilitate banks to collaborate or acquire the new technology. Banks could also outsource or internalize new technology. Would it disincentivize innovation? Very unlikely, if the new technology is appropriately priced. This brings us to the key issue of regulatory arbitrage. If we want to avoid the inefficiencies caused by differential regulations for similar activities across different entities, a non-bank undertaking banking functions needs to be licensed and regulated like a bank. Without the license, it should not be allowed to undertake banking activities. This, for example, is what RBI in essence did recently when it clarified that prepaid instruments cannot be funded out of credit lines, because it enabled an entity to undertake a licensed business without a license. That regulation clearly established the principle of same activity, same regulation. More generally, as long as innovations are compensated with appropriate market-determined pricing, maintaining consistency in regulation would encourage innovation and enable absorption of new technology non-disruptively. On the issue of customer protection, experience has taught us that market forces are unsuited to protect customer interest in the absence of regulation. Just excuse me for a moment. Sorry. Experience has taught us that market forces are unsuited to protect customer interest in the absence of regulation. Whether it is the derivative market or the LIBOR setting, unregulated markets eventually lead to outcomes that are inefficient for customers. RBI's data localization guidelines are intended to secure users' payment data. RBI's warnings on cryptocurrencies and its public stance was motivated as much by policy sovereignty as by the need to protect uninformed investors from being soaked. RBI was perhaps the first central bank to openly call for a complete prohibition of cryptocurrencies in India. It is now recognized globally that a total ban is a valid policy option for any country. It is a distinct possibility that ambiguous or equivocal stance of regulators or authorities globally has contributed to the surge in demand and valuation in crypto products in the last 2 years. RBI's caution has perhaps contained the damage in India. In the payment space, India is one of the few countries that protects users through two-factor authentication. Although now it is recognized as an innovative regulation, at the time RBI introduced it about a decade back, there was a pushback and criticism. Similarly, the recent measures such as better customer control on card usage, shorter turnaround times for transaction failures, tokenization, etc., are all initiatives intended to protect the customer. Regulation of digital lending apps is another example of regulations aimed at responsible practices and customer protection. A key innovation of financial inclusion and providing credit to entities that lack access to the traditional financial systems, these products, apps, platforms, whatever you call them, nonetheless raised a host of business conduct issues such as unfair business practices, opaque interest rates, and unethical recovery practices. As a percentage of overall loan portfolio of banks and NBFCs, digital lending represents a very small fraction. It was probably 0.31% and 0.51% respectively for banks and NBFCs. While still rather small, this potential needs to be realized, but in a responsible manner. RBI had earlier, in June 2020, advised banks and NBFCs to adhere to fair practices codes and outsourcing guidelines. Given the emerging concerns, comprehensive directions were issued recently in September. These regulations specified the entities that were permitted to lend, transparent loan and pricing norms, and fairness in treating customers. In this context, an unexpected regulatory challenge that we have faced, and that is typically particular to the fintech segment, has been what one might characterize as compliance aversion. Financial entities traditionally subject to regulation understand that regulation serves the larger objective of systemic stability and development. Consequently, their initial entities outside the financial space are still learning to adapt to a regulatory environment. Consequently, their initial response to regulation is sometimes an objection. Ironically enough, the narrative created to justify such objection is usually customer inconvenience, even by industry bodies sometimes. The norms prescribed for recurring payments was criticized as inconvenient to customers until a survey revealed that more than 80% of customers actually welcomed the move. Although to a lesser extent, similar friction is occasionally exhibited even by regulated entities, as can be seen in banks' shunning of the FX retail platform, which would significantly improve pricing for retail buyers and sellers of Forex in our markets. RBI's approach to regulatory aversion in general is to patiently ease in regulation, give the ecosystem adequate time to adjust. There are a couple of other issues related to regulation or related to fintech that I'll cover before I close. One of them is global coordination. A unique challenge for regulating fintechs is the need for global coordination. Since these services are online, and as in the case of cryptocurrencies, they span across national boundaries, effective regulation would require global coordination. Since technology by its very nature evolves faster than regulations, regulators would usually be playing catch-up in the process. A global common understanding of the risks involved and about the nature of regulation is necessary for regulation to be effective in the fintech space. The issue is further complicated by differential impact of such technology in different countries. For instance, stablecoins would not pose as much of a threat to a country whose currency is used as a peg as it would to other countries. Evolving common understanding on the risks posed by fast mutating technology is therefore likely to remain a challenge, and a challenge that needs to be addressed. The other aspect I wanted to cover is the internationalization of innovations. RBI has always played a developmental role in the financial sector. This developmental role has prodded it to not only make many technology initiatives itself, it has also started the process of extending the global reach of India's premier innovations. Internationalization of Indian payment systems is a policy objective of RBI. After successful enablement of QR code-based payments through UPI at merchant locations in Singapore, UAE and Bhutan, RBI is collaborating with the Monetary Authority of Singapore to enable cross-border person-to-person remittances in an instant and cost-effective manner. Additionally, we have allowed deployment of UPI-like systems in Nepal. Engagements are ongoing in multiple countries for UPI QR code-based payments, person-to-person payments, and developing UPI systems UPI-like systems in other countries. To provide a more efficient alternative to private cryptocurrencies, RBI has embarked on the journey to introduce CBDC, digital rupees. It is expected to work as another efficient choice along with existing payment products. Digital rupee can facilitate transactions in locations with limited or no connectivity and therefore further financial inclusion. Going forward, it can effectively be used for delivery of government subsidies and benefits and for any targeted payments using the feature of programmability. Among the various benefits of CBDC, perhaps the most important is its potential to make cross-border payments faster and cheaper. Here again, a necessary precondition is that countries develop their own CBDCs, and there is a global understanding on the need to make CBDC systems interoperable, basically by linking various CBDC systems, and develop standards for effective interfacing. I would close with that. Being a regulator, I'll just close by saying that being a regulator as well as a central bank, RBI's regulation needs to be responsible to national interests as well as responsive to user needs. In the area of fintech, creating an ecosystem to incentivize and harness innovation is a prime driver of our regulatory approach. In this era of global fintech markets and fintech revolution, RBI's mandate is to protect sovereignty and serve public interest. Our efforts are aimed at making regulation consultative and collaborative while maintaining policy independence. Thank you.